Hey, everybody. Welcome. Here's another Calling All Investors live with Caeli show. Today is January 31st, 2023, and we are live with Caeli. Today, we are going to talk about two very important topics that we polled the community on and found out that you wanted to know more about. Caeli, can you guess what those two topics are?
I think I can. Let's see if
yeah, let's see if we can
ESP.
tune into each other. I got the first one. It starts with owning and financing properties in an LLC. Is that what you were
Yes.
thinking, Caeli?
Yep, it's exactly what was on my mind.
Awesome. And I know you know this next one, though. This one I'm going to see if you know.
Does it start with an A?
It does start with an A.
The all-in-one.
It is the all-in-one. It is all about the all-in-one. So today, for those that have come, thank you very much for coming. Again, every Tuesday, we're here together, 4:30 p.m. Eastern. And if you are part of the live event, please feel free to use the Zoom tools to either ask a question through Q&A. Feel free to use the chat also. We've got that running. And if you're listening to this on replay and you want to know more information, please head over to the Ridge Lending Group community, ask additional questions. You can obviously see the video replay if you're listening to this on a podcast. And as always, Caeli, if anyone has any questions they want to speak to you or any of your other dedicated lending specialists, just give a call to 855-74-RIDGE or email to info@ridgelendinggroup.com, or even just go ahead and start an application and let one of the team help you out by going to ridgelendinggroup.com and starting away. So Caeli, how about we start with owning and financing properties in an LLC?
Absolutely. Thank you, Larry Bailey. Hey, everybody. Can you believe that we're through January of 2023? I know that, that kind of stuff is thrown around and, oh, I can't believe we're this far into the year, but I truly cannot believe a whole month is down for 2023. We're off to a great start. Very excited to be with you today, as always. In fact, this is probably the best part of my day today. It's month end, so this is a welcome reprieve. Feel free, everybody, if you want to turn your cameras on so I can see your lovely faces. Let's get to it. Owning and financing in an LLC. I want to start by just quantifying that and what an LLC is. What does it mean? What does it do for us as real estate investors? I would say 9.9 times out of 10 individuals that come to me that want to have their property in an LLC is almost always for asset protection, right? That layer of anonymity. More often than not, when we finance a loan in an LLC, maybe a commercial loan, it's going to be recourse, which means you've signed a personal guarantee, which is really going to be the same exact thing as any conventional loan that you close in your individual name. The only time, if your need for an LLC isn't exclusively for asset protection, the only time that LLC will afford the extra, whether it be for tax purposes or having zero liability whatsoever, is going to be that non-recourse commercial loan. And on a non-recourse loan, no personal guarantee, the loan and title will both close in that LLC name, but be prepared that the terms are not going to be as attractive. A non-recourse loan is going to not allow for a fixed rate option. You'll never get a 30-year fixed on a non-recourse product. So if that's important to you, you're not going to want a non-recourse. The rates and terms are also not going to be as favorable. Interest rates are going to be higher. You're probably looking at a balloon feature where the note will be due in 5, 7, or 10 years versus an ARM, an adjustable rate mortgage that simply will adjust. Interest rate will change based on a 5 or 7 or 10 year, right? Those are the differences between the two. So the first thing about LLC and financing into an LLC, you need to identify what is the purpose, what's the why behind your desire to have an LLC. Chances are, if you're talking to yourself right now, it's for asset protection, in which case I would say the following. The loan does not need to close in the LLC name. Okay, it can close in your individual name, and you can simply execute a quit claim deed, QUIT, quit claim deed. Some state that's called a warranty deed, but more often it's quit claim. You can execute that quit claim right after closing and transfer the title from your name, from Caeli Ridge, into my LLC. It's 5 o'clock somewhere. That's the one that I like the best. I heard that maybe 10 years ago, and it's been my favorite LLC name of all time. It's 5 o'clock somewhere. Without any due on sale. So there's still some bad information out there, or old information rather, where people think that on a conventional basis or any loan that closed in the individual's name, if they were to execute quit claim and drop it from their name into their LLC, that there's that due on sale clause, that language that said that the note would be called due. That is no longer applicable. That is old hat, old news, as long as you, the individual on the loan, holds the majority ownership of the LLC. So you'll have to own 50.01 or more percentage of that LLC in order for that due on sale not to be a valid concern. Anybody have any comments, questions so far based on everything that I'm saying?
So a couple of things, Caeli.
Yes.
First of all, for those that are hearing this topic, the LLC topic for the first time, there actually is an article posted. I'll put the link in the chat here, and then we'll reconnect that link in the recording show notes, where we actually list out the Fannie Mae due on sale PDF, Caeli, that you've made available for everyone, as well as the Freddie Mac due on sale, to help support what you're saying. And there is a question, a couple of questions coming in. First question is, do you need or should you hire an attorney to create an LLC, and does it change from state to state?
So Larry's going to make sure that he reiterates this. We are not attorneys. We're not giving you legal advice. In answer to that question, I haven't needed, that's not true. At one point, yes, we had real estate and tax attorneys that handled most of that for us. However, when establishing an LLC, you guys, it's such a simple process. Unless you have 20, 30, 40 plus properties that you really need that extra help, you can simply go to the Secretary of State website in the state that you're looking to establish the LLC in, and that does not need to be in the state in which the property is located necessarily, okay? A lot of times I find that investors opt for the extra that comes with the Nevada and the Delaware and the Wyoming, right? There's extra anonymity there. So whatever state that you're looking to establish maybe in your home state, whatever. Sidebar, note that if you do establish an LLC in the state in which the property is located, you will be required to now file a state tax return for that property, for that LLC, okay? So it may not be necessary to do it that way. I avoided doing it that way very early on because I didn't want to be filing 40 different individual state tax returns. So Secretary of State, go to the Secretary of State, whatever state you've chosen. You'll be able to identify real quickly within the search of the website how to set up your own LLC. It probably takes you 4, 5, 6 minutes to do it, and maybe it's $100 to establish, and then there's an annual fee. So in answer to your question, no, I don't think it's necessary to utilize an attorney's services for that and the extra that they may charge for it. It's a very easy process. At least it has been every time I've done it. Maybe different states have different complicated factors. I couldn't speak to all 50, but I would definitely investigate it for yourself before you spend hundreds or thousands that may not be necessary.
Great. Thank you very much, Caeli. And in the chat, for those that are following along the chat, a couple of things. I just put the link in there for the community link that talks about these two due on sale PDFs. It's funny, Caeli, Michael just posted a more of a comment in the chat when we're talking about transferring properties between person and LLC. And Michael's recommendation was better to do a warranty deed, otherwise your title insurance is no longer valid. And I'm just smiling because we just talked about the issue of owner's title insurance in terms of making that transfer. So great call out, Michael. Thank you. There are a couple of other questions, Caeli, on this.
Sure.
So Michelle asks, how do we express ownership percentage for lender? Does that question make sense?
Yeah, it'll be in the articles of the LLC that you've established. So if you were 100%, it would say in the articles of that entity, right? If you were all on your own, it would just say 100%. If it was you and a spouse, typically it says 50-50, but you'll be able to designate that within, I guess, the bylaws of the articles of incorporation of the LLC.
There you go. And Jamal asked the question, if I have each of my properties, total of 28, in their own LLC, can I get a 30-year fixed conventional loan for one of those properties?
Hi, Jamal. Let's assume first that all the other qualifications are met. Okay, the number of finance properties you have, debt to income ratio, credit, all of that is perfectly acceptable. The answer would be yes. However, To close on a conventional loan, you'll have to take it out of the LLC for the purpose of closing, and then you can drop it back into the LLC the very next day if you choose to, assuming we meet the condition that you have more than 50% ownership in that LLC. Keep in mind one more thing when we start talking about this, guys. There are different counties in different cities around the country that transferring that title ownership via a transfer tax can be very, very expensive. I'll tell you that there are counties in Pennsylvania that, you know, on a $300,000 property, transferring from your name to the LLC and the LLC back to your name, or whichever way you do it, could be thousands and thousands of dollars. So make sure, it's unlikely, it's not as it's pretty uncommon actually, but it's common enough that you should double check that before you get down that road and not know that this is going to be a hefty price tag that you weren't prepared for.
Great. Thank you very much, Caeli. That's all for the questions right now. If anyone has any other questions, feel free to use either the Q&A feature or the chat. If you feel like you want to talk and put yourself on camera to do that, you can do that also. Just raise your hand or let me know you want to come on camera. Jamal did have a response though, Caeli, to you, sure. Which was that Jamal owns all properties 50-50 with Jamal's spouse. Okay. Would that be a quit claim? So would it be a quit claim transfer just before closing and then back?
Yes, as long as, so Jamal, in that case, you're going to have or change the articles so that your ownership is 50.01 and or your spouse will have to be on the loan with you, which depending on your circumstances, my initial reaction would be that I would not recommend that. We want to maximize each other's golden tickets, right? And if you're going to be obligated to the debt, both of you on one property, that chews up an extra spot that would have been there if you did it separate. So 50.01, go ahead and read, Jamal and anybody else that wants to, the link that Larry put in there, Fannie and Freddie seller guidelines, and the portion that you want to pay attention to is even highlighted within the PDF documents. It'll tell you exactly if you're going to do this and you want the conventional financing and you want to keep it in that LLC, it tells you exactly what you have to accommodate in order for it to be legal within their rules and no due on sale clause in effect.
For those who are just joining, Caeli's been talking about owning and financing properties in an LLC. If you have any questions before we move on to our next topic, feel free. Katie, I have your question. I'm going to ask keep Caeli on topic here for what we have, and we'll see if we can fit your question in here before the end.
Okay, so yes, I'll talk about Series LLC. I see that one, Larry.
Okay.
So just to recap, in the LLC, guys, you can do it in a conventional, keep it in the LLC if it's for asset protection. If there's something else that you need that LLC for that's not just about asset protection, then your only option really is going to be a non-recourse commercial loan. Okay, and for those of you that weren't with us initially, a non-recourse means there's no personal guarantee attached whatsoever. You will not get a fixed rate mortgage on a non-recourse loan, and the terms are not going to be as favorable on a non-recourse loan. Just think about it this way. The less amount of skin you have in the game, the less competitive or attractive the terms are going to be, right? The more skin in the game, the more competitive, the more attractive the terms of the loan are going to be. Series LLC. So the Series LLC, for those, and I'm no expert on this, okay? I just kind of know the baseline stuff. Series LLC is where every individual property has its own unique LLC created and assigned to that property. And then you've got the master LLC, and everything bleeds up into that master LLC. I'm not sure, and I'm very open to hearing other people's ideas and thoughts and strategies about this. I'm not sure that the Series LLC affords us that extra protection that I believe its intent is. And in fact, more than that, I think that it really complicates financing. Because if you're going to get into a loan where it's that full doc, where you've got to provide your tax returns and your vials of blood and all that stuff, the paper pushing and paper trail that you're going to have to supply to a lender to, let's say you've got, 10 properties. We're going to need to see every single LLC document and all of the paper trail from that document up until the top, up until the master LLC. It's a lot. It becomes a lot. I've had clients that have had many properties that had done it this way. And the amount of brain damage that it took to underwrite those loans for both the lender and for the borrower was no small thing. So, and I don't know that it provides the extra layer of protection that I think that it's touted to do. You know, I usually, for me, I'll usually have 3, 4, maybe 5 properties per LLC. I typically won't have more than that many in one. I don't want to put all my eggs in one basket, of course. But 3, 4, 5 in the one has worked perfectly for me. And I've shared this with many people in the past. In 25 years, the amount of times that I have needed that LLC protection, this is me personally, right? Here's the disclaimer again, I'm not an attorney. I'm not giving you guys legal advice. Larry, you're welcome. But for me personally, in 25 years, I've never found myself in a situation where that anonymity has been necessary or needed for my protection, right? I've never had anybody come at me with a lawsuit for anything. Maybe I'm the minority. I don't think so, but and everybody's circumstances are different. There's a lot of investors that simply get extra coverage, right? They'll get extra umbrella coverage, liability coverage that, for $1 million or whatever, that would circumvent the need for LLCs. Some people are more comfortable with that. So I guess that more than answers the question.
I think so. Yeah, I think so. And again, just as Caeli said, Ridge Lending Group, Caeli Ridge, nor I, Larry Bailey, are financial licensed individuals in the accounting field or in the legal field. So please do yourself a favor. If you have any more insights that you wish to investigate about this, please visit with your professional who's properly licensed in those areas, especially when it comes to matters of LLCs in specific states. There are attorneys that specialize in that I'm sure can be very helpful, giving you options. Terrific. Caeli, there's no more questions about the LLC.
Okay.
Did you want to move on to our next topic?
Yeah, let's talk about the all-in-one. It's been a while. So, and I see some new names here. For those of you that have been with us every week for the last year plus, thank you for your continuing to listen. Some of this might be redundant, but the all-in-one is my absolute favorite loan product on the planet, I would say, for the right individual. I'm going to kind of just touch on the basics, and then maybe we can go into some higher level stuff. And of course, any questions that you guys have. The all-in-one, it's called the all-in-one because this loan takes both a mortgage and your checking and savings accounts and combines them into one, whereby depository income from all sources, doesn't matter if it's from your W-2 job or your gross rents or your dividends or your interest or your alimony or your child support or whatever it is, it doesn't matter where the source of depository income is coming from. It's going to take that depository number and it's going to drop it into your checking account where your line of credit lives. It's a home equity line of credit in first lien position. So whatever the balance is on that day that you put the deposit in, it's going to drive that down dollar for dollar. Now on any HELOC, whether it's the all-in-one or a second lien HELOC, which most of us are more accustomed to understanding, interest accrual happens every single day. And that interest accrual is based on two things. One, that day's balance and that interest rate. In this case, it's a monthly interest rate, and it can change monthly based on a margin and an index. I'll come back to that in a minute. So every single day, there is a snapshot taken of what the interest for that day is going to be based on those two things, an interest rate and that day's principal balance. So obviously, the lower we can make that balance via our depository income, the better, right? The less interest that's going to accrue. There's a compounding effect at work here, so that the more income you drive in there for the longer period in a 30-day billing cycle, the better, right? Every single month you're doing this. Easy math example that I tend to give in this case is that let's say that you have a balance on your line of credit, your home equity line of credit of $100,000, and you have $10,000 a month of depository income from all sources. And also for easy math, we're going to say that you get that $10,000 on the very first day of the month. You're going to deposit in your $10,000 on the first of the month. So your $100,000 balance is now what? $90,000, right? So interest accrual is going to be based on that $90,000. I'm going to leave my $10,000 in that account for 29 out of a 30-day billing cycle. Okay, I'm going to leave it in there for as long as humanly possible. Now I have things that I need to pay for and spend throughout the month, right? I've got living expenses, I've got bills. So what I'm going to do in order to optimize the use of the all-in-one is I'm going to use a credit card. of my choice or credit cards of my choice. And I'm going to pay for my food, my gas, and my utilities and my car payment and my mortgage payments and whatever other expenses that I have are going to go on this card. Before the card itself accrues any interest, I'm going to go online on day 29 where my 10 grand has been sitting in my checking account, which is fully automated, by the way, and I'm going to pay that credit card off. Okay. Now going into the first day of the second month, in my scenario, I am able to save about 10% of my monthly income every month. So in that case, I've got $1,000, right? 10% of 10,000 is $1,000. I have $1,000 left over every single month. So, and that's just going to sit there. I have 24/7 access to my money at any point in time that I want. But while I'm not using it, I'm going to let it sit idle the way it would be in my checking and savings at B of A or Chase or whatever over here doing nothing. I'm going to leave it here. Now, on the first day of month 2, what's my balance? Not 100,000 anymore. It's 99,000, right? Because I had that 1,000 left over. It's staying in there. It's left in there. So on the first day of month 2, my $100,000 balance is 99,000. I get my paycheck on the first. I drop in my 10 grand. So now my balance is 89,000, right? For 29 days out of a 30-day billing cycle. So you can see that's the second compounding factor at work that is reducing the amount of interest that can accrue. This is kind of an arbitrage, you guys. If anybody has ever heard of velocity banking or infinity banking before, that's what this is conceptually. But we're utilizing it in the form of a first lien HELOC and a mortgage that attaches that checking and savings component and feature with that mortgage. Real quickly, and I'll open up to questions. The banking features, like I said a second ago, fully automated. Online bill pay, you got routing numbers. You can do auto deposits with your checks, your income from all sources can just drop right in there. You've got debit cards, you've got paper checks if anybody still uses a paper check. You even have phone apps where you can take a picture of a check if you still receive checks as form of payment that'll just automatically upload into the account. Everything that you have now, you have with the all-in-one and that connection with the two components. Actually, you know what? I said I was going to open for questions. Let me go back really quickly and define the mechanics of the interest rate, because that's probably going to be mostly what maybe has follow-up questions for. So 2 components, and this is an adjustable, and any HELOC is going to be adjustable, whether it's the all-in-one or a second lien HELOC. Okay. The components, you've got an index and a margin. The index is variable. There's dozens of indices out there. Okay, those can move up and down, east and west, sideways, whatever. Index can change. The margin can never change, ever. The addition of those 2 numbers is called a fully indexed rate, and that's how monthly, via the all-in-one, the interest rate is going to accrue. The index used for the all-in-one is the 1-year CMT. This is the US Treasury. Anybody that's interested in this, I would greatly encourage you to do your Dear Google search for the 1-month CMT and do a 25-year look back, okay? 30-year look back. What you'll be able to find is massive amounts of data where it will drill down to exactly every single month for the last 25 years, exactly how that index posted. And then you'll be able to get some averages so that what you're going to be able to see, what it will illustrate is, 1, how often does this index move? And second, by how much? Right? It's a very slow moving index, all in all. I believe currently, and it changes obviously every month, but the current average, 25-year average for the one-year CMT is 2.6. I'm going to have to verify that statistic, but I believe 2.6 or in that range, within maybe 1/8 of a point difference. So that plus a margin, right? The fixed, and a margin for a primary residence would be 3.75, and for a rental property it would be 4%. So right? That's not what it is today. 2.6 is not what the index is today. That's the 25-year average. But anyway, 3.75 for a primary residence is the margin, 4% for a investment property. Let's open up to some questions, Lara.
It'd be helpful if I took myself off mute. So Stephanie asks, do you offer any HELOCs for investment properties?
Yes, yes. The all-in-one is applicable to primary, second home, and investment properties. There are, per individual, you have technically access to 3 all-in-ones. Okay, you could have 1 for an investment, 1 for a rent, or 1 for a primary, 1 for a second home. However, depending on your individual circumstances, it may not make sense to have more than 1 all-in-one for the primary focus that if you're taking your depository income, and let's just keep using my numbers, you've got $10,000 a month, does it make sense, right? Does the math work to your advantage still if we split that 10,000 up into, say, 2 equal parts, right? I don't know if you guys can hear that. Sorry, it's ringing. Whoops. So am I going to get one on my primary residence and one on my rental property, where my $10,000 a month, 5,000 is going to go in over on this one and 5,000 is going to go on this one? Does that improve my situation? Now, one of the cool things about the all-in-one that I absolutely love, and I really, really would encourage you guys to check this out. Go to our website. At the very top of the page, I think it says all-in-one simulator. There's an online interactive simulator that will allow you to plug in your variables, your information. It's very easy intake. It's nothing crazy. It's like 3 pages and it's very, very simple. No credit pulls, no documents, no nothing. It's all for you to kind of play with the numbers. But it'll compare the all-in-one to either an existing loan that you have on a property today or a new loan that you may be getting, whether it be via a purchase that you're looking at or a cash out refinance on a 30-year fix that you're looking at. You can take that and compare it to the all-in-one numbers. Or again, you can compare it to a loan that you have in existence today and see how they stack up. The coolest thing about this is that the math won't lie. As long as your input is accurate to what it's asking, right? And there may be some disconnect there. So we would want to spend some one-on-one time, right? If you think it's asking for X and it's really asking for Y, your results aren't going to be valid. So when I send people to the all-in-one simulator, I have them play with it for themselves a little bit. And then I almost always insist that we get back together and do one-on-one screen share where we can look at the simulator together. One, I can make sure that what it's asking for is what you input. And then finally, I do believe that for most people, some interpretation of the results is usually necessary.
Terrific. Thank you, Caeli. We do actually, Ridge Lending Group will actually set up calls specifically to go through the simulator because it is complicated.
It is. It really is.
I would ask, this is more of a quick question, just to follow up on Stephanie, who asked about the investment property. Mixed use, you allowed to do mixed use with all-in-one?
No, unfortunately, Stephanie, just residential, single family up to 4 unit. Condos are okay. Case by case, non-warrantable condos are okay, but nothing commercial.
There you go. So Katie asks a clarification. So the clarification is, so you're not actually paying off the balance with the depository income, but it creates a faux balance for 29 days to save interest. Then the last day of the month, the actual depository income balance hits whatever's remaining after you've paid your credit card bill. I think there's a little bit of a misunderstanding. And so the way that the question's written, Katie, I don't know if you're able to come on. If you're able to come on, I can offer you to unmute. You can ask your question directly to Caeli. But I think there might be just a misunderstanding of when, if you were to take that $10,000 that you mentioned earlier, I think there's a misunderstanding of what is the actual balance of the mortgage while that $10,000 exists in the checking account.
The balance is going to be the difference. So
Katie, looks like Katie,
okay.
Yeah, so let me see so Katie, I just gone ahead and give you a chance to unmute.
Okay, thank you. Larry, can you hear me?
Hi, Katie. Yeah, I can hear you.
Hi. Okay, so my question, so I didn't quite understand the concept of it, I think is what's going on. So what I heard was that you essentially have like 2 separate accounts, if you will. So you have the loan and the whatever balance you have that you haven't paid for yet, and then you have this depository account that's sitting alongside of it. And for the majority of the month, based on the system is looking at it as if it's sort of netting the two, taking whatever your balance is and netting the depository account amount against it, such that you're saving some level of interest during that time period. But the actual payment hits at the end of the month. So you still have access to that 10K, if you will. But you're saying basically don't spend the money in that 10K depository account. Use it for your credit cards and then take the money at the end of the month, pay off the credit card. And then I guess maybe the last day of that month is when the actual payment hits to pay off the balance of the loan. and that's how you're getting to save, or that's how you have the arbitrage? I'm not sure. Maybe
Yeah, you're so close. You're so close. I really think, guys, that visual aid is so impactful and really connects the dots. But I'm going to rephrase just one more time, Katia. So if you think about on what the interest accrual is on my example, on $90,000 on day one. Okay, I'm just going to use a number. Let's say it's $10. That's not the number, but I'm just trying to keep the math simple. So I've got $10 on day one, $10 on day two, right? We've got a 30-day billing cycle. So for 29 days, right, $10. So I have $290 worth of interest for that month that has accrued, okay, versus if it was $15 at 100,000, right, I would have that much interest accrual after 29 days. All right, so simply all, and don't look at it as two separate accounts. It's really just all in one, right? It's now your checking and savings. All you've really done is you've gotten a first lien HELOC, and now you've taken the vessel in which you've got your checking and savings today, whatever bank you're using right now, and you're simply replacing that with this. Nothing changes, absolutely nothing. It's not two accounts, it's one account that mirrors, that allows you to become your own bank. You're using your income to reduce the amount of interest that can accrue in as quick or as slow as you deem based on your variables, based on your numbers. Let me also preface you guys, this is a complicated loan. Okay, many of you have probably heard me say this. I've been doing this work in finance for a long time, and the first time that the all-in-one was introduced to me, I had a meltdown. I had to look at the thing for 2 weeks every day until and relook at it and watch it and relook at it until the dots connected, until the light bulb came off. So for those of you that this is a very new concept for, please be patient with yourself. It's going to take some time. One of the biggest things that really I struggled with is, okay, give me a second, I'll explain. There is technically no payment due on the all-in-one. Okay, this helped me. I'll give you another example. Let's say that I have a credit limit of $200,000. That's my limit, but I have a balance of $100,000. Okay, if I chose, and this is not what the product was designed to do, but I'm illustrating a point. Stay with me. If I chose, I would not have to make any deposit ever in that account until such a time that my balance is about to reach or exceed my limit. So let's just say that the interest accrual in the first month is $1,000 a month, and I didn't make one deposit into this account. At the start of the second month, my balance is going to go from $100,000 to $101,000, right? And so on and so forth. So technically, I don't even need to make a deposit into this account. And some people use it for that and use it in that way for that purpose or for their purposes. But my point is that the depository income that you're putting in there kind of simulates a payment, right? It's reduced interest. And then what's left over at the end of the month also simulates another payment, right? It's being left in there. One of the examples that you're going to find with the all-in-one is that it's going to compare, let's just use our 30-year fixed counterpart. And let's say that the 30-year fixed, based on the terms that we input to the simulator, are $2,000 a month. That's the payment for this other mortgage that we're comparing to the all-in-one. The all-in-one assumes that instead of that $2,000 going back out the door to make that payment, that it's going to sit here instead and drive that down, along with the lump sum of everything that you're going to put in there for 29 days out of a 30-day billing cycle, plus whatever you have left over, your discretionary spending, your after your savings, right? What comes at the end after everything goes out the door. The all-in-one will not work for the individual that has more bills left at the end of the month. Like if you have $50 left after everything goes back out the door, the all-in-one will not work for you. And the simulator will tell you that. It'll be very clear that says on the results page that the 30-year fixed is crushing the all-in-one if it doesn't work for your circumstances. I really think maybe if you guys want to do a quick vote in the chat, what we should do next week, if everybody's game, is we should do the simulator together. I will share my screen and we'll go through it. You guys can be going through your own scenario at the same time, and then I can interpret your individual results with what the example is I have on my screen. I don't know if I'm helping answer the overall question. I think Kadia really requires that visual, but tell me if you have a follow-up question.
Yeah, no, I think it shifted my perception of it, certainly. Like it's I think I get that it's one, as you said, it's one giant account, and basically you have, I'm not sure if I'm going to articulate this properly, but it's seeping in, I'll just say.
It's going to take a
seeping in
minute.
slowly. It will probably take another iteration of explanations, but I think I'm gathering that at the very least that you're using it as a way to, especially if you're paying off your bills at the end of the month, you're using it as a way to pool all of your actual income or deposits into this account to net against this loan, or to reduce the interest rates.
Right.
And then basically you're playing the game of just making sure that you know, whatever actual expenses you have that you need to pay and that you're using the credit cards outside of this for, that you are, you know, it's below whatever it is that you're making, if that makes sense. I'm not sure if I'm
I think so. Yeah. Let's
Yeah.
do that. Let's see who wants to do this next week. We can do the simulator together. Even if you've seen this before, you guys, it's probably worth a you know, revisit so that we can kind of go through a scenario. Blair, how many?
Yeah, we've got, you know, we've actually, I think that was one of our unfulfilled promises for last season, Caeli, was to actually do a simulator. I think we talked about it a few times. So let's make sure we just do that for next week. We'll do a big announcement.
Okay.
We'll have a big simulator party for real. And then Katia, the one thing I will agree with Caeli on, because for us, Caeli and I are literally on opposite sides of the country, but our career arcs have really fell in alignment. And when I first heard about the all-in-one, it was actually with Ridge Lending Group. And for me, it made total sense because it's banking combined with a mortgage. So it's technically, in my world, it's called a sweep account. Most people have no idea what the hell that word means, but the point is that you put all your money in one place. So instead of having your paycheck go to your checking account, and then you move your money to your savings, and you move your money to your mortgage, or you move your money to your HELOC, it's all one account to make it really simple. So there's a ton of information on ridgelendinggroup.com. We're going to absolutely do the simulator next week. So I fully encourage everyone on the call today, as well as anyone listening to this replay, please go to ridgelendinggroup.com, go to the top and follow the instructions to start your simulator. Make sure that you take advantage of saving your results. There'll be a key generated for you, and Caeli can actually use that key to bring up your results on her screen and look at them directly without having to put you through any more aggravation. How's that? Is that a deal? Is that good homework, Katie? Is that what you're going to do for us?
I won't promise for the next couple of days, but I'll scramble on Monday.
I'll take it. I'll take it. That's awesome stuff, Caeli. Anything you want to add? We did have a question back on the LLC just to wrap us up for the day.
Sure. And I look forward to seeing you guys next week. The all-in-one simulator will be good. I promise it'll make a lot more sense, Katia, once you've seen this with your eyeballs and you know what it's asking. And yeah. LLC.
LLC, Corey. So Corey asks, if you purchase a property in your name and then move it to an LLC, the question is, won't it show in the chain of title that you have ownership or own the property? Question mark.
Yes.
Don't most people move into a corp of any kind to reduce personal exposure?
Yes, the answer to your question is, yeah, the chain of title, if let's say you're being sued, I would say a good attorney, if you know, whoever is suing you has a good attorney, they're probably going to do 12-month chain of title, maybe a 24-month chain of title. But the other thing to consider is that, Corey, it's very unlikely, it's not saying it's impossible, but if your property is in the state that you live in, then it'll be easier to identify, right? That's usually, if you're being sued in that state, that's probably where they'll start. It's highly unlikely that you'll find an attorney that's going to do more than a 12 or 24-month chain of title search all over every 50 states of the country, because what they're going to have to do in that case is they're going to have to pinpoint. So the chain of title is going to be in every county, in every city of the United States, in all 50 states, and come up with a match for Corey Brown. In your case, I think you probably have a little bit of an advantage because it's a fairly common name, but you're absolutely right. If you purchase it with your name and then you transfer it into the LLC, that record of Corey Brown will exist initially, right? So depending on how long you have the property or how much time passes before somebody decides to be litigious and try and sue you, yes, that will be there. Now weigh that with potentially having increased insurance coverage, right? Liability and coverage, see what that cost is versus the cost of that non-recourse loan that I was talking about that starts and stops. Or you could look at non-QM where the loan itself is in Corey Brown's name, but title will close in the LLC name. That's kind of middle of the road. So just real quickly, guys, I know we're a little bit over. If we were to go straight conventional, the loan and title are in Corey Brown's name. That's how we close. A non-QM loan, which is the next tier up, favorable terms won't be as favorable as the Fannie Freddie, but the loan is still in your individual name. You are personally obligated to the debt, but we're closing title in the LLC name. In the event of litigation, they're not going to have any idea about the financing, right? There's no way that they'd have access to that information, but they will have access to the title. And if it closes in the LLC, that's all they'll ever see. That chain of title won't be broken. And then finally, you've got that closing in the LLC name loan and title, but that comes with two different things. You've got the personal guarantee, and then you've got the with a recourse loan and the non-recourse with no personal guarantee. And either one of those should not matter whatsoever as it relates to liability protection, right? It's just a matter of the terms, if that makes sense, Corey. Let me just say that one more time. If you're looking at a loan where both the loan and title close in that LLC name for the purpose of asset protection, it's not going to have any impact. For you, it only matters what terms you're more comfortable with and whether or not you want to give that personal guarantee. Whether you give a personal guarantee will have no impact on that chain of title and opening up to additional liability from a lawsuit perspective.
Awesome. Caeli, I think we've done it. I think we spent another roughly 40 minutes educating the world, and you should be proud.
Thank you, Larry.
Yes, it's very good stuff. For everybody else who's come and listening, thank you very much for coming. We love doing these, and I'm not kidding when it's Tuesday at 4:30 p.m. Eastern. Caeli's like, finally, I can do something fun, and I can smile, and we can laugh, and these kinds of things. So please keep coming. Caeli loves seeing everybody show up, so feel free to interact at all of these. As always, you can always call Caeli or any dedicated lending specialists at 855-74-RIDGE. or email to info@ridgelendinggroup.com. Check out that simulator. It's the real deal. And it is, again, between Caeli and I, we've got almost 300 years backing experience. She's got more than me.
That's a lie. He's older than me.
But in any event, it is a solid product, and we do help a lot of clients with it for all owner-occupied, second home, and investors. So it's an awesome thing. Caeli, thanks as always.
Thank you, Larry. See you guys next week.
Take care, everybody. Bye-bye.
Bye, guys.